All right, we are here with Eric Balchunas. Eric Balchunas is a longtime friend of the compound from even before we were calling this the compound. And Eric is, in my estimation, the very finest ETF reporter in America. What do you think about that? Is that too much?
No, I'll take all of that, except I'm technically an analyst, although I do reporting.
Can you imagine?
But wait, hold on. We also love, there are
He
others.
is the finest analyst who does reporting.
He is on the Mount Rushmore, let's put it that way.
You definitely are. You're in the top 5.
100%.
Okay.
Top 20.
I'll take it.
Top 20
Yeah.
probably.
But I'm an analyst.
No, but you have this roving, so you're at, well, let's set this up first. So you're at Bloomberg. How long have you been at Bloomberg?
21 years.
Whoa.
That's incredible.
Yeah.
Okay. 99?
2000.
2000.
Yeah.
So I'm very good at math. And you have one of the best podcasts in all of finance, not just ETF specific, and it's called Trillions. Tell us about Trillions.
It's a podcast I do with Joel Weber, who's editor of Business Week.
Shout out to Joel.
And he is not an ETF guy, so he sort of tries to keep us, speaking normally.
Yeah.
So it's kind of a half ETF nerd, half normal person podcast, and we just try to simplify ETFs for people. And ETFs are fun because they send you everywhere. That's why I like covering. So we cover everything, basically.
That's such a great point. Covering ETFs means covering business.
Yes.
And everything that's going on.
Yeah.
Because there are ETFs related to every segment of corporate America, the economy. So you really have a big breadth of information.
I like to say, you kind of have to be a mile deep and a mile wide. Some jobs you just need to be a mile wide and an inch deep.
Yeah. Well,
or a mile deep and an inch wide.
You do it very well. And we were talking before, the last time I saw you was Inside ETFs 2020.
Oh, man.
January 2020.
Yeah.
Okay. Michael's
before.
got two-factor authentication. He's trying to get into the doc. So if Michael's very quiet, that's what's going on right now. We'll give you some time, champ. So I saw you there, and then the conference thing, just the curtains dropped, and then there were no events.
It was over.
It was over. Very, very
It went dark.
abruptly.
Everything went dark.
But what I want to say is you're part of this roving band of ETF geniuses, and you guys have this routine that you do where any conference that's at all related to asset management or ETFs, if they call you guys, you get on stage, and it is easily the most fun, most informative part of whatever conference it is.
Talk about that crew.
Who's in that crew?
It's a good crew.
Tom Lydon.
Tom
who we
Lydon
love.
he calls it the ETF nerds. It's Lydon, Elizabeth Cashner of FactSet, Ben Johnson of Morningstar, Dave Nadig, Matt Hogan.
Murderers. All murderers.
I'm missing somebody.
Did you say Todd?
Todd Rosenbluth, of course.
Can't forget
yeah,
Todd.
I mean,
Biggest nerd of all.
Yeah.
Todd's the one that will hear this and call.
I know. I love
so
Todd.
you know.
I don't know. We click, and also we're not really bound by the way an asset manager is bound on stage. They can only say certain things. They got their PR person right there. We're pretty free.
Is Jeffrey on
So
that panel or no?
No,
No, Ben is.
Ben is.
Yeah.
Ben. I guess
Jeff,
reps Morningstar.
Patak?
Yeah.
No,
Morningstar.
he's the understudy when Ben Johnson can't make it. Right?
Ben's at most of them, and sometimes only 3 of us show up. We might do a Canada event, and there's maybe 3 of the 6 or 7 people.
Who's the Michael Buffer of the ETF industry?
Michael Buffer?
Yeah. Who's
Hogan.
Hogan. Hogan, that's right.
It's not going down if Hogan's not announcing it. You know what I mean?
Yeah. Hogan, yeah. I think Hogan and Nadig, in particular, those 2 guys, I think were doing all this ETF stuff and in this informal fashion way before anybody cared. In fact, that's how I got into it. I was listening to their podcast in 2005.
Wait, what? Who?
Matt Hogan and Dave Nadig.
No shit.
They had
There was
a podcast
in 2005?
about ETFs. And they would get on and kind of rip each other a little bit, and then they get into these details about ETFs.
Rip each other?
Yeah, I mean, they
How many ETFs were in 2005? Was there
at the time
20?
Podcasts weren't that informal back then, at least financial ones. Now it's more normal to do that, but I found their informalness and also their ETF knowledge and just their whole vibe was I could tell it was 20 years ahead of its
They're
time.
the
Or
best.
15. Yeah.
How many ETFs were around in 2005?
Not a lot. Probably 1,000. Now there's almost 3,000.
Are there still more indexes than stocks? Remember that nonsense?
Yeah, that chart is, well, first of all, there are technically 3.7 million indexes.
But just share classes and
Look,
there's
you can
no
index
money
everything.
invested in any of them.
So my Meb Faber has a famous way because everybody freaks out about that chart. They're 3.7. This will end well. That whole thing.
Inflation.
Yeah, and then they're he's well, there's also more words than letters.
true.
Ooh.
I would go with music too. How many notes are there? 9, 10?
Yeah.
And how many songs have been written?
Right.
Yeah.
Meb
But
is-
my
Meb-
metaphor though is also
Meb is a badass.
only a handful will actually matter.
Yeah.
Right. So the rest are just like the songs and the words. I bet we probably only use like 3% of words. I would say the same thing for
You know, they say
indices.
you only use 20% of your brain.
You only use 20% of your indexes. What a shame.
Even less.
Because those other 80%. So all right. So you guys.
That line from Wedding Singer.
Yeah.
You only use 20% of your heart.
So you guys are the ETF geniuses. And when did you start covering ETFs for Bloomberg?
At 2006, I was in data and I was doing mutual fund data.
Right.
And the woman who covered ETFs went on maternity leave and never came back. So they were like, "Hey, can you now cover ETFs too?" And I just sort of kicked the tires on
And that woman was
them.
Janet Yellen. Tell the whole story. All right, go ahead.
No, her name is Amy Samolowicz.
Okay.
So
Our loss.
she's
Your
really
gain.
cool. Anyway, so I sort of covered them, and I was like, these things are pretty cool. And then I went to a conference or two, and I just heard some people talk, and I just read up on them, and I'm like, wait a second, these things kick ass. Like they're like 5 evolutionary steps ahead of a mutual fund, not just one.
Yes.
So I was like, this is a wave that's going to break. Let me
How
get
much
ahead of the wave.
how much
and I
money
just
was-
became an expert. I read everything I could.
How much money was in the ETF complex at that time? 500 million?
Less than $1 trillion.
Less than $1 trillion?
Yeah.
Oh, 500 billion?
Yeah. So I would say
Even
maybe
that sounds
500
high.
billion, something like that.
Really?
Yeah.
Okay. So now what is it? 7?
7 trillion.
Holy shit.
Yeah.
Oh. Eric,
Holy
did
shit.
you? Well, actually, this is a great segue. Josh, tee this up. You know what? I'll tee it up. You are writing a book. I thought it was going to be called The Big Long. That's not the working title. You don't have to share if you don't want to. Do you want to share or no?
Sure. A big long is a chapter in the book.
Okay.
I was going to do a whole book about that, but I ended up using it as a part of a bigger book, which is called The Bogle Effect.
The Bogle Effect.
Yeah, which is I sat down with Jack Bogle 3 times for over an hour in the 5 years before he passed away. We exchanged emails. I had like a lot of material sitting here, and I was just like, I really want to get this out. And I also felt, as someone watching flows all the time, I'm like, man, almost every dollar invested today, you can kind of trace back to Vanguard of the mutual ownership structure. And so I was like, let me try to really capture all that in one book. And then you could say, if somebody was like wanting to learn about funds or how we got here, I can say, here, read the Bogle Effect. And if you want to learn about ETFs, read my other book called The Institutional ETF Toolbox. So I feel like the Bogle Effect covers everything beyond the ETF, which ETFs kind of came in 93. But he was doing all his thing starting in 74. And I also found it interesting that nobody has copied the mutual ownership structure since. You get this large asset manager, and I was like, why? And so I interviewed all these people, and they were like, well, because there's no economic incentive to do it.
Yeah.
So then I was like, well, why did he do
How
it?
could I pay myself less?
Yeah,
You're
so
surprised
nobody wants to
came
drive a
up with that?
Volvo.
Right.
Nobody goes to Wall Street to drive a Volvo was one of the quotes I got, which is really good.
Well, because why? Because it only works at scale. And how do you scale that?
Even then, nobody would willingly turn over all the future profits like that.
So, but,
Back to the shareholders.
But,
yeah,
well, wait
it
a
just
minute.
it's like it's
But
almost
they
like
started that way, though.
They did.
started that way, and that's the difference. Then you're not turning anything over. Nothing exists. Nothing exists.
well in the
Was
end.
Vanguard the first DAO?
It's basically like a DAO, but with like a very, very powerful Jack Bogle really calling the shots for many years.
Yeah, I mean, the structure actually happened through this really insanely quirky, serendipitous situation where he was fired. And so he was pushed up, his back was
By
against the
Wellington?
wall. By Wellington. And so he needed to come up with a solution to this major rift in between him and his partners who were trying to get rid of him. And the one thing they would let him do was run this dumb little back office company that was owned by the funds. And that was Vanguard. And so at the time, but he could have left and started a company and tried to make money. Like he could have, I think that's what most people would have done. The idea that you would willingly stay there, first of all, and then make this company that's owned by the funds, that was his idea, is unique. And
he needed their infrastructure and their backing to launch something.
I bet there's somebody out there who was the legal mind who said to Jack Bogle, like, no, here's how you do it, right? Because how did he think of that?
Person would be 90 years old right now.
Yeah, you're not going to find them.
His Princeton thesis has a lot of this sort of the fund industries to serve the investors. There was some groundwork laid early on, and he claims he had thought about the two masters problem before this situation. So
Who were the two masters?
The two masters, he thought
Obi-Wan Kenobi.
Yeah.
No, this is something different.
And
God and
people.
no.
Admittedly, I didn't read I didn't do the required reading for this segment.
No, it would be the two masters being the shareholders and the investors. So those are usually there's a tension between their two desires. Shareholders want money, and the investors arguably want more return. And so those are usually two different parties. They are at every asset manager. They're the same. And so once he got locked into that, he really became a evangelist for it. But look, the reason I wanted to write this particular book was the interviews I had, but also just the idea that my premise is the Vanguard, that structure, which continues just as the bigger it gets, the cheaper it gets, is powerful. And it is really the root of everything.
Can you just describe when you say that
indexing
structure?
To me, in other words, if indexing hadn't come around, right, Vanguard would have had 5 basis point active funds, or they have very cheap active funds, let's say, and they would start beating all the other funds. They would be the biggest active shop 3 times over right now because they bring a gun to a knife fight because they're so cheap. So it isn't really the indexing revolution. Indexing really was a perfect partner to the mutual ownership structure, but it would have been big regardless. And now it might move into other areas. So it's just beginning.
So the mutual ownership structure, just to like visit that topic. So basically the shareholders who own the funds, the investors, de facto own the company that provides the funds, which is why you don't have this layer of people paying themselves $5 million each to like administer this fund company.
Correct.
Okay. Because everyone is aligned.
Yes.
Yeah. What if we did that as an RIA? We're not going to. But what if we said we want our clients to own the firm, and we'll own the firm along with them? What would that? How would that look for a business that's not a mutual fund, but is clearly has the capability to be a customer-owned partnership?
Well, I think it would come down to if you had a big year and you had more revenue and profits. The question is how to spend those, and
NFTs.
Yeah, the question is answered, my friend.
So how would you spend them? So I guess
you have a board that makes that decision. You're saying,
yeah.
So the board would be made up of executives and clients of the firm.
People represented from the investors that they elected.
Okay, so a lot of firms in our industry are starting to put together advisory boards of their clients, which if I were a better CEO, I would have done this already. But I do think there's a lot of value in having your clients have representatives who are among them, have a seat at the table, not to dictate to us what to do, but just to tell us. Like, we do surveys and stuff, but like just to be like a voice for the rest of the clients. I should probably set something like that up. I feel like that's powerful.
Yeah, I agree. There was a story
We'll do the whole thing on chain. Like, I feel like we could do that very efficiently.
Yeah, I think you should do it. I mean, I always thought the like NFL and like I have an NFL shirt on, but like sports should have like fans every time they sit down to figure out what to film, how to do it. I think that you should always listen to the people who are consuming the product.
totally
Listen, I swear I can run the Giants better than Gettleman.
Yeah, they really should have more of this across every single industry.
But that's why the fans fall in love with the owners that come from among them. Like, like somebody like Mark Cuban, he's like obviously not a common man, but somebody like Mark Cuban who was rabidly
he seems like a fan.
He was a massive basketball fan, which
you can
is
just
why
tell. You feel it.
It's why he built broadcast.com
Sure.
so he could watch, I guess, Indiana University games or something. So like if you think about like some of the most beloved, popular owners in sports, a lot of them like the fans really can relate to, and they feel like this guy is on my side, even though they're obviously the owner of the team. They're not. So I think there's something to that.
All right, Eric, so you're writing this book, The Bogle Effect, and this sort of idea has been in place for a long time. I can't believe, I want to read something from Josh's post. I just got stuck. His post, The Relentless Bid. This came out, Josh, you wrote this in March of 2014. Do you remember this post?
I'm busy taking a bow. Go ahead.
This is 2014. Let me just read the first quick 3 paragraphs. You hear it all the time these days. There is a relentless bid underneath this market just waiting to buy every single dip. And you can't really argue with the statement itself. The dips have become shallower and the buyers have rushed in more quickly each time. Sell-offs took months to play out during 2011. Think of the April-October peak to trough 20% decline for the S&P. In 2012, these bouts of selling ran their course in just a few weeks. In 2013, a few days. And thus far in 2014, just a few hours. It's rather extraordinary. I've been thinking about the reasons why for a long time now, and I believe I've got my answer. My unified theory of everything, so to speak. I'll lay it out below. So Josh did that in 2014, and it's funny because this is when, in October of 2014, I think the first time I remember, holy shit, these V bottoms, like they just keep happening, was the Ebola scare. Remember that?
Yeah.
Was that 14?
That was October 2014.
Okay.
That V bottom was so insane. And I was like, that caused me to look back on this post and on the history of what's happening. So what happened and what's still happening 7 years later?
Well, so I think ETFs play a really big role in this, the way in which they're used by advisors. And you would agree, most flows are directed by advisors in the ETF land, right?
Yeah, I think
For the
maybe
most part.
75, 80%.
Right. So what are the ramifications for the stock market when every advisor is going from being a transactional stock slinger, which is what I used to be, becoming an asset allocator instead, and more importantly, automating the schedule on which they're going to buy and sell based on something other than what's going on in the market. And that's, you get this relentless bid, and it doesn't mean that the inflows are positive every month, obviously, but you get this relentless bid that comes from advisors pressing a button and buying the stock market for 500 clients all at the same time, and doing that on a regular schedule, which I think contributes to those V bottoms and at least the speeding up of the processing of bad news. So the jux to my piece was, as brokers turn into fiduciary advisors, that bid's not going anywhere. And it looks like it turned out that way.
I would agree. If you look at
the Fed.
The Fed. Well, the Fed is major.
Of course.
I mean, I think they've almost eliminated tail risk, or at least the feeling that there's tail risk.
That's super top.
Yeah.
You shouldn't say that on my podcast.
Okay. Sorry.
Go ahead.
I mean, I polled this. I said, do you think, I actually asked everybody, it's like, do you think that if there's a really bad sell-off, the Fed will step in? I think 80% of people said yes.
Why did you do this?
I just polled Twitter, like, I don't know, maybe 2 months ago, 3 months ago.
But what is a really bad sell-off?
2020-ish, something like that.
2000. Oh,
Yeah.
so we know they will because they did.
Yeah, but I mean,
Good poll.
I don't think anybody is like 5%. I think that's why Powell can talk about like tapering and doing all this stuff. I think at the end of the day, they know he will bail them out. So I don't even care what you say.
Yeah, he's data dependent. The data is the fucking 200-day moving average.
But as long as you feel that they'll step in, it's like there's really no reason to panic or to diversify even, or like hedge or short or do anything.
Or worry about leverage.
Yeah.
Right.
So I think this whole relentless bid is a little more Fed-driven, and I'll tell you why. Because even though ETFs take in money, rain or shine, and Vanguard, even during sell-offs, they tend to have net flow of positive inflows. Over the last, 5-6 years, the money out of active equity mutual funds has been about the same as the money into passive ETF and index mutual funds. And in fact, in the last 2 years, they were still net negative on equities. So I think a lot of the ETF flows, honestly, are a format change, but still, I think people, like you said, are much more dip buying, and they've been rewarded for buying the dip.
Isn't there a demography story there though? Because like I remember reading, I don't think it's Savita. Who at Merrill Lynch does the flows? Hartnett, the Flow Show or whatever. I just remember every week, like the update on the flows in and out of Merrill Lynch accounts.
Yeah,
and they break it up. They do hedge funds. They do retail. I forget what the third category is. Maybe just regular institutions. And somebody I was like writing blog posts utilizing this data, trying to understand who's buying, who's selling, like a dog chasing his tail. And somebody finally sat down and said, "Hey, idiot, that's Merrill Lynch. Everybody there is 70. Of course, it's net outflows. They're living on the money."
Yeah, so I was going to say that. Josh nails it. So it's not. Do you think the money coming out of active is going into indexes? Because I don't. I think the money coming out of active is going to bonds.
I think it's going to the supermarket and medicine.
I agree with that.
Because where are bond inflows coming from?
Yeah, so I do agree, because there's this misconception that active equity outflows, because sometimes they're net over months and years, is warm rebalancing. It's a natural effect in a bull market, right? You get your percentage equity goes up, you need to sell and buy bonds. I agree, and I think you're right. There's probably boomers and older people who are cashing out of their active equity mutual funds. I don't know if they're putting it into ETFs. All I'm saying is it is offsetting to a degree number-wise. But I'm with you. I think the younger RIA and
and at this point, you're not
But
going to
stock prices are going up, so it can't be fully offsetting. It has to be biased toward more.
Well, this is a question
More
I
demand.
posed to Twitter, and I'm honestly not totally sure I've got different answers, is if fund flows in the equity world are generally flat, how is the stock market moving up so much? And I've received many different answers.
Well, not all the money coming in is from funds. That's the easy answer.
Yeah.
Let me do this. This is Nick Colas at you know Nick?
Yep. I don't know him well, but I know who he is.
All right. I think he's like one of the better. I think he's a brilliant
He
guy.
works for the Minneapolis Fed.
So Nick's at Data Track, which is his own research company. This is what he's saying about flows recently. For the week ending October 27th, fund investors bought $9.9 billion of U.S. equity funds. That's mutual and ETFs. Okay.
$9.9 billion.
Yeah.
Okay.
In a week.
Okay.
This was the second straight week of solid inflows. Last week was $9.4 billion. The prior 4-week average is essentially zero, $68 million a week. So the last 2 weeks are notable considering they're coming in at new highs for U.S. large caps. So what are we to make of that?
I know it's happening. So basically,
the flows accelerate at a high for the market after being quiet.
Yeah. So we divide flows into ETFs used by retail and buy and hold, like Vanguard, Schwab, iShares, and ETFs used by traders. I think what he's acknowledging is that the trader crowd has come back in, and they tend to be momentum-ish. If the market starts coming back, they're going to just pour a bunch into SPY. And there's institutions who might equitize cash with SPY. They get something in, they just buy SPY. So SPY and the Qs are probably where a good chunk of that $9 billion is coming from. But if you take
that's
that
money,
away,
not like chasing the high.
Yeah, that's like I call it hot money.
Well, they can't, right? If the market's about to make a record high, which it just did, that's the money that can't be left behind.
Yeah, in fact, I know. I just looked at the flows last week. I think SPY, the Qs, IVV, those are the ones that are taking the most money now. That said, if you stripped all that away, that's more like a sort of volatile flow pattern.
Yeah.
You're still going to find money coming into VTI and VU like rain or shine, like clockwork.
So can the relentless bid, or can the big long money, like the advisor money that's coming in, the 401k money every 2 weeks, can that dampen a sell-off when it gets really violent?
I think so.
I think that's exactly what it has been.
People think it's going to amplify
volatility.
it. Yeah. Yeah, I agree. So I have a chart in the book. I go into some of the worries.
When's it coming up, by the way?
Not till April.
Okay.
But I'm just about finished the last version. Takes like a couple months to get everything together. Anyway, I have a chart showing GE. Remember when GE had that nasty sell-off in 2018, I think it was? It went down like 56% in like half a year.
Yeah.
We have a chart showing GE going down, and then we have a chart of all the ETFs and index funds
Buying
that hold
GE.
it.
Right.
So the bars of the flows are real high, but GE is tanking. So that sort of proves that the tail isn't wagging the dog.
Thank you.
That said, GE might have been down 65%, 64%. So I do think that index funds are creating a natural bid to maybe buffer sell-offs. And my theory is in the next sell-off, what we're going to have happen, and we saw it in 2020, all the people who own active mutual funds are going to bail. They could be $2 trillion out in a year because in March 2020,
why? Because their cost base, their capital gains go away.
They're older. Yeah, that's one. Yeah. They're older. They were probably put in the fund by somebody. They didn't buy it voluntarily, right. So there's no loyalty. And so they're just like, look, I got to get out of here.
Yeah.
And so in March 2020, it was unbelievable the intensity of outflows. There was $350 billion that came out within like 4 weeks.
Oh man.
And so we wrote a note saying easily $1 trillion will come out, but then the Fed stepped in. So I have a bigger theory that the Fed
big-footed
I
anyone's
think BlackRock and
wildest
PIMCO,
dreams.
who all have people who work at the Fed and vice versa, I have to think they're all communicating, being like, look, we're going to have to halt redemptions. So I think you could almost argue that active bond mutual funds are the new too big to fail.
So the stock market,
you can't let them fail.
The stock market drives monetary policy.
Well, I also think active bond mutual funds, because you remember during that time, the Fed, it seemed like equity mutual funds were seeing outflows pretty bad, but it wasn't until the bond mutual funds started getting hit hard. They saw $180 billion out in 2 weeks. And I was thinking to myself, at some point, they're not going to be able to sell bonds. And they're going to have to say, we can't redeem you. The ETF can still trade and people can yell about the discount. But a mutual fund is at some point, I think, going to have to halt redemptions. And if they do that, I think that would create panic.
Is this the silver lining of the revolving door between policymakers and large systemically important financial institutions?
Well, also the
they're
boomers,
all friends.
Yeah, I think I call my phrase for it is the boomerati.
Okay.
That's what I call it. Because Trump and Biden are clearly on the same page, Powell's on the same page, and they're from very different parties. But I think also if you look at the stock market, and you have charts on this, who owns the stock market? Boomers.
Right.
Yeah.
What do they own, like 80% of it?
Yeah.
It's their retirement savings, and they're in power.
It's the whole generation.
Yeah,
is
why would they
riding
let
on
it fall?
Right. Let me ask you this. We were talking about how
this is just it's a little bit of I know I sound a little crazy with that.
No. So all the flows in the world can't save a bad business, right? GE was a $300 billion stock, however big it was. All the flows in the world can't stop it. But what about at the smaller end? Do you see flows impacting stocks on the smaller end, stocks that just get included into the Russell 1000? Kathy Wood stocks, not in 2021, but in 2019, 2020. Like they could definitely.
Well, ironically, Kathy's active though.
Right.
Yeah. So yeah, certainly if a big fund, I have another section in the book where I call medium fish and medium ponds, or medium fish and small ponds. Sometimes an ETF will be supposed to be small, like, I don't know, the junior gold miners. And for some reason, it just catches root and it gets too much money and it becomes like a medium fish in a small pond. I think then the index has to expand to make like room for bigger cap stocks in there, which is what the junior gold miners did. There was a case with Tanger Factory Outlets, which was over 50% owned by passive.
Wait, what happened? Oh, I remember that story. What happened to the GDXJ? Did they put Apple in there?
They just increased the size of the index. Yeah, Apple. Yeah.
Well, one last thing on this, and then we got to move.
I think we had spent an hour talking about this.
I know. This is probably boring for most people. I love it, but
what about it's definitely not boring for most people. The people that listen to this podcast are here for this.
Okay.
What about the role of 401k being so indescribably larger than it was during prior bear markets? And I think this is a big volatility damper, and I talk about it all the time. So how much money did you and Ben figure out financial advisors have?
Oh, it was you. 23 trillion.
Okay.
By the way,
I got the right number. I talked to Cerulli.
Okay.
It's 25.7 trillion.
I was stuck on 13.
I'm going to forget my thought. So 23 trillion is basically
25.
Financial advisors all knowing their clients are staring at the same actuarial math. The market pulls back 5%. They pull the lever, more equities, because it's what everyone's clients need, and nobody's making money bonds. So that's happening. And then on a parallel track, 401k money, every 2 weeks, I don't know, 100 million Americans get paid, and money, regardless of conditions in the market. We have definitive proof that nobody f***ed with their 401k allocations during the last crisis.
Yeah, Vanguard showed that.
So that money comes in as the ultimate volatility damper. It's coming right out of paychecks. The majority of people have no idea that the VIX is up, and that comes in, and it is a price blind, completely fearless purchaser of stocks.
Okay, to a point, but if you take the 401k money that's in sort of the Vanguardian lane and you take in, say, the RIAs who use Vanguard ETFs.
Fidelity, it's huge.
Okay, let's even add in Fidelity. We're probably at about, 15% of the stock market. There's households own 45% of the stock market.
Right.
I always say, like, everybody's worried about ETFs. Like, what about these households? What do we know about them? Like, they're really, they're half the market.
But Eric, how big were 401ks 20 years ago?
I agree. They're bigger and
more meaningful.
Yeah. But is there anything, I'm not sure if there's anything wrong with that. I think the bigger question is that should the stock market be America's retirement savings?
Too late. Too late.
If not what? If not this, then what?
Yeah, well, then it would be like a defined benefit.
You want to go back to
situation.
You want to go back to pensions?
Yeah, that worked out well.
That didn't go well.
So, in fact, one of the things in my book I'm looking at is why has international markets not been as quick to adapt passive investing? It's because they're just not as good at consuming. And part of the reason Americans are good at consumption in the investment world and have sort of moved over to the sort of like fee-based advisors and to passive is because they sniff a good deal, because they're used to looking at their finances because of 401ks made everyone learn how to at least analyze a couple funds. Whereas in Europe, they don't have to do any of that. So there's a less interest in the markets in general.
In Europe, if you're rich, you own land.
So
you don't care about the stock market.
They're largely with commission-based brokers still, and they're largely in active funds. So passive and the Vanguard effect has been a little slower over there because there hasn't been that consumer culture.
Canada's like us.
Germany has an ETF savings plan now, though, as part of their retirement system, which you probably know more about than I do.
They all want to be like us,
yes.
I think it's just hard to get there from where they are. And I think that's why I think ultimately the whole globe will end up looking like us. But this is part of the sort of
gatekeepers in Europe have kept passive out more successfully because the families that have money there, it's sitting at the same bank that their ancestors have been dealing with for 500 years. Like in Amsterdam, they have 500-year-old banks. In Italy. So
they get charged like 2%. Like
they don't even call themselves financial advisors, though. If you sell mutual funds to a bank client in Europe, you call yourself a fund selector. That's the nomenclature. I'm not even kidding.
Right.
So they don't have RIAs.
Yeah.
Like it's nothing like here at all. I want to do this thing on commission-free trading and direct indexing.
Wait, let's start with this.
Let me ask you a question.
Okay.
Like you guys are RIA here. Would you do you ever think about expanding into another country or like
Rotterdam?
Well, twice last year. We think about it all the time, but there's no avenue to really do that right. We spoke.
But
mean
I did
internationally?
hear when I talked to people about this, some
Yeah.
people were like, well, there's no evangelist like a Bogle over here. There's nobody really shaking things up. So with your
Canada.
well, no, this was in Europe essentially when this person was talking about this. You know who I was interviewing who gave a lot of, it was Robin Powell, who you guys
yeah.
know.
Yo, if
He's an
Bogle,
evangelist.
He is.
Yeah.
first of all, if Bogle was doing what Bogle did here in Europe, the Illuminati would have gotten him. Didn't you see Da Vinci Code? There would have been like a ceremony.
Yeah.
There would have been sex involved, and they would have cut his head off. Robin Powell actually probably should get full-time protection. I don't think
He's
that'll ever
fascinating.
get shaken up.
Yeah.
It's like this ancient.
I love that
thing.
he got told to leave. He was asked to speak at a conference. Said, "Oh, I think indexing's good," and they were like, "Oh, excuse me, sir, you have to leave."
Yeah, but very politely.
Yeah, very politely.
Hilarious.
Yeah.
We love
but
Rob.
yeah.
We love Rob.
Let's talk about let's get into this topic. Here's a good way to get into it. So Jared Dillian likes to kick the hornet's nest.
I love him.
I didn't hear this podcast, so maybe this quote is taken out of context, but I don't know if it needs context. Here's what Jared said. Zero commissions has been the worst thing that happened to retail investors in my lifetime.
LOL. I want to hear the rest of that now. What podcast was he on?
It was with Meb. I didn't. So,
Okay.
so Eric, what's your take?
I already know what he was saying though.
I interviewed Jared for my book, and I have almost that exact quote. He said the same thing to me.
All right, so
He
contextualize
said
that for us.
he's basically like, fees aren't necessarily bad. And also, I talked to Dan Egan, who studies psychology, and he made this point that when you go from like very cheap to free, people
love a deal.
People lose their minds.
Yeah.
There's something with that. So you could make the argument that $5 a trade is actually healthier than zero.
I totally think it is.
Yeah. And so, but the bigger point here is these investors they haven't had their ass handed to them with a real sell-off because it all started after the Fed came in 2020. If they get a down market, they're going to sing a different tune. Plus, they're young.
But so
they
what?
don't
They have
have
no
a mortgage.
money.
They're probably not married. They don't have kids. So I was looking in the book. I go into 1999. If you read Fortune and Forbes article from 99, they sound exactly the same. It's like these chat rooms and everybody's getting rich and quitting their job at whatever store. And then that ended. And a lot of those people ended up becoming like buy and hold, boring investors.
You know what the difference is? This time, it's 10 times bigger. Like, it's so much bigger. We
And
have
the Fed.
$1 trillion companies. They're going to bring this fucking Rivian public next week.
Yeah, but wait, hold on.
No.
The numbers are bigger. But
No, the
not,
business
the story is
bigger.
the same.
But not everybody's trading like they were in 99.
But-
everybody in 99 was trading. Don't you think?
Everyone now is trading.
Think so?
Yes. Actually, I would bet
So
it's
I
even
have
more
numbers.
widespread during the pandemic.
So Larry Tabb at Bloomberg Intelligence, his awesome data. Basically, 20% of all the equity volume
It's nuts.
is retail.
It's nuts.
But that is up from 10% 10 years ago. But guess what? It was 14% in 2020 before the pandemic. So it literally jumped from 14 to 20 immediately after the Fed stepped in. That's when it. So I think it's probably at an unnatural elevated state. It would probably come back down if there's a
How
sell-off.
much of that was Portnoy? Definitely a piece.
If I had to rank, I would put the Fed way above.
Sure.
Portnoy, but-
Do we know what those numbers were in 99? Or do we not have them?
you speak to.
I gotta look.
You ever speak to like?
It was low.
You ever speak to like 20 something? I do all the time. You ever speak to 20 something traders?
What do you mean you do all the time?
I do all the time. All the kids from my neighborhood, their older brothers.
So on Trillions,
I'm
we
telling you, I like have conversations with 20 something traders. You know what they say when you mock the crypto or how they're trading on Robinhood? They're like, all I know is I was watching the news and I never watched the financial news. And I just heard them talking for 5 minutes about how the Fed was able to like magically make $1 trillion out of thin air. And you're saying that my shit is bullshit? Like they're smarter than I would have given them credit for. I'm not saying it's like cerebral. They just don't have respect for any institutions. They watch institution topple. Like, look at the CDC. It's a clown show. So now you want these people to respect the traditions we have of commissions and buy and hold and like prudent investing. They're like, look at the world you built. It's crumbling. It doesn't apply.
The other thing I'm starting to hear from crypto a little bit, which is interesting, is they normally go after gold, but they've started to go after the S&P 500 a little bit.
It's not enough.
Because
it's not enough for them.
Well, because it's like this is a Fed pumped up. The valuations make no sense. It's not real. Why would you encourage somebody to buy that now, knowing that the valuations are, I don't know if they're at all-time highs, but they got to be close.
And Bitcoin people don't give the Fed any credit for 60,000.
Well, no, they do.
Okay.
What they're saying is you shouldn't I think the idea of encouraging investors to just buy a Vanguard S&P 500 fund now, they think is almost like a pyramid scheme, like just get the younger people in so we can sell because we know it's also inflated, which I love my stocks, but I see that point a little bit in that you could argue that trying to get people to buy into stocks now is the top or at a point where it's almost ridiculously high.
But young people are dollar cost averaging a little bit every 2 weeks. They don't have a lump sum to drop in at the top. So it's like a moot point.
Well, also the crypto tends to be like anti-Fed. Like they're
Sure.
basically like this is like real value, and the Fed has just made everything worthless in the dollar. So this I think ties into that narrative.
They're not all wrong. Like
There's good points here. I have gotten to know the crypto crowd a little more since the ETF came out, and I've been reading up on it, and it's fascinating. I definitely give it much more credit and interest than I did before. And also, we were talking earlier, they're fun. They meme. They have a sense of humor. Some of them are out of their minds. Yeah, they really make investing entertaining to a degree, and I like that too.
All right. In the 12 months through June, the 11th largest U.S. retail brokerages collected $2.2 billion for selling customers' options orders.
Oh, it's from your boy. That's from Larry.
That's Larry Tab. That's payment for order flow. That was 60% higher than their take from selling equities orders.
Why are options so lucrative?
The spreads are wider, so that's why they want to pay for those. Also, meme stocks. The spread on AMC.
And the trading is more reckless.
You know what the spread on AMC was during the whole thing and GameStop? It was like 20 basis points. That's like 20
stock.
That's why they were paying up the nose to get that flow.
Right.
I don't think the apes cared. But by the way, there is the whole thing about day trading. So back to the Bogle book, just because it's fresh in my mind. He did a study.
We're gonna link to it. A lot of people are gonna buy it. Don't worry.
He did a study that was basically saying that in the 1999, he wrote this article about the day trading. He claims that day traders only get 65% of the stock market return. And that's even worse than active mutual funds, which he claims get 75%. So he said, obviously, in index, you get 100%, but he thinks it's even worse. And, he hates active, right? Or he is trashing active his whole life, that the day trading gets any, but I don't know if they care.
Are you glad that he didn't, not that he's gone, but that he didn't have to witness what went on last year?
I asked people what he would have said, and some of the comments were really funny. They thought he would have been like, he probably would have, somebody said his head would have exploded.
I met him for the first time 3 months before he died. For some reason, he agreed to take a trip up to New York from Pennsylvania, and he was at the Tiburon CEO Summit. He was like the keynote speaker. It's like a room full of CEOs only of like wealth management companies and asset managers. And it was a Q&A. He didn't have to do like a song and dance, but I never met him before. Barry's met him a bunch. So like he's sitting on a stage. He's got his cane. It took a big effort to get him up the steps to the stage. So I just went 10 feet away from him and just right in his line of sight. And I just said, I just wanted to tell you how much I appreciate everything that I've learned from you and that you've done for the industry. And he gave me, I don't want to say he winked because that's bullshit, but he kind of did a nod and there was a gleam in his eye. I think he probably was a little bit aware of me maybe.
Yeah.
And that honestly, that would made my month.
Well,
so.
he loved that. In fact, in the book, part of what I explore is he seemed to be immune to money, but he definitely couldn't get enough of praise. So I think that some people have different things that feed them.
That's such a good point.
And so while he wrote a book called Enough about corporate greed and all this,
good.
He had some kind of. But normally people who don't care about money don't go into Wall Street. That's what makes him unusual. He probably would have made more sense in a different industry. So he was almost miscast because of that internal need.
Could you imagine
praise over
if
money.
he went into a different industry, he went into Chipotle and he was making the guac free.
Well, I think
the customers own the.
I have
the
a theory
food.
that he almost went into hotels.
Okay.
Yeah, because the reason he went into funds is because he was just looking for a thesis in the Princeton Library, and he just happened to pick up Life magazine.
Okay.
And in there was this article called Big Money in Boston. So he read it and he goes, okay, this is cool. I'll write my thesis on that. Then he got a job at Wellington. The rest is history.
Okay.
I was looking at other magazines that month in that year, which I believe was 59.
Okay.
And Time magazine had Conrad Hilton on the cover. So I was just imagine, how big a part luck plays in one's career. If he picked up Time and was like, yeah, this hotel business seems pretty good.
Dude,
Let me go into that.
The only reason I'm sitting here is because my dad played golf with a stockbroker and I didn't have a job. So yeah, 100%. 100%. Don't even ask how Michael got here.
So obviously this is like asking a barber if you need a haircut, but the chief legal officer, Dan Gallagher from Robinhood, and we don't need to go into him, but not that I have anything bad to say. I don't even know why I said that. Payment for order flow coupled with technology has helped make investing less expensive and more attainable for millions of investors of all backgrounds. True.
Yeah, I think that what I would push back on that, and what I also look at in the book is the difference between like Betterment and how they're trying to get you not to trade.
Yeah.
And Robinhood, which is trying to get you to trade. It's made by the same, the people who make other apps that are supposed to be addicting. So it almost seems like Robinhood is almost made like a cigarette.
Yeah.
And what Betterment and some others do are trying to get you off of smoking. I found that sort of juxtaposition interesting.
All right, fine, I'll say it. All right. So speaking of that, like the smoking part, this
Angel and Devil on your shoulders.
This just reminded me of Thank You for Smoking. Remember that movie?
Yeah, great movie.
So
Underrated.
Dan Gallagher got paid $30 million by Robinhood last year.
Hold on, what's his title?
He's the chief legal officer.
How many hours a night of sleep is he getting on average?
They paid him $30 million. That's like Steph Curry money.
Do you think that he has an entourage? Like the chief legal officer of Robinhood sweeps down the hallway with like uniformed security.
You know how like when a president goes in, he ends up like with way more gray hair. They age so quickly.
100%.
I feel like that's the same deal with that job. Like you have to be so overwhelmed.
It has to be.
With stuff, and you probably have a 4-year
or a complete and total sociopath. Could go either way.
But wait, here's another thing. So what Robinhood did with zero free trading is obviously they steer their customers to trade. We know that, but it opened up the door to direct indexing. When we were working with Canvas with O'Shaughnessy's, we were trying to figure out our model. Like, how is this going to work? Because it was asset based pricing. It was not cheap, and they busted the doors open and broke the dam for us.
To explain that to the viewers, if you're doing custom indexing, you're trading every day, a lot of it for tax loss harvesting. If that's on a commission basis,
can't do it.
You're basically like churning up an account. You can't do it. So you have to request what's called asset-based pricing, which is basically like how much are the assets in the account. Okay, we'll bill based on that, which is not the norm.
So that was 20
industry.
basis points ish.
Yeah.
And for a big, that could be real money.
So then they go no commissions.
It depends on where you go, right? If you go to Schwab and you do that.
We were at TD and Schwab. They both simultaneously said no commissions. And then it's like, oh, this Canvas thing does make sense now because it's
my two
economic.
Pushbacks on that, or my questions for you guys is, if the trade's free, obviously in Schwab, the way they would make money is taking your leftover cash and moving it to
we don't have leftover cash.
Okay,
we're
so then you
we're
dodge
the worst
that.
client on earth because we cash manage.
Yeah, okay, so take that away. And then there is also the spread of the stocks.
Don't care.
Take it. Somebody's gonna take it.
I don't care.
Yeah,
sell
but
if you look at sell my order flow to China.
It depends how much you're buying. No, but I mean, I'm talking in order to buy those stocks. That's why the ETF, I would argue, has a point on that. Is that it's typically 1 basis point, and the basket, whatever it tracks, unless it's large cap equities, is going to be usually a little more. Even a large cap basket, I think, would be like 2 or 3 bips.
So we don't care about that. But somebody who's allocating like a $10 billion trade.
Yeah, it's fine. I get it.
No, they care.
And if you can make up more on the tax part of it, it would totally overwhelm that. Yeah. I get it. Although that does run out.
I think the future.
I mean, at some point, and also if you're doing all this tax loss harvesting, my question is, is it getting confusing with, oh, now I'm not tracking the index because I sold this, bought this? Like, you're able to completely maintain.
It's pretty wild.
Perfect tracking.
Well, no. It's not perfect, but it's pretty damn close. It's close. It's more than close enough.
Okay.
Have you kicked the tires on any of these things yet?
Yeah. No, I think for certain clients, this is a great thing who have real into taxation.
Not for everybody, obviously.
Yeah, but I think generally Ben Carlson of your shop, I think, is all into simplicity.
Yeah.
And I think if you look at where all the trends are going, they're going to simple, cheap, and passive.
Yeah.
This reverses all three at once. And anything trying to dislodge VTI or a Vanguard.
Oh, it's not going to dislodge VTI. But Eric, here's what it does.
It's not trying to do that.
It's not going
It's not sentient.
Go ahead, finish your thought.
Well, I guess my question is, if you're going to go into direct indexing, right, that would be the core of the person's portfolio, right?
Yes.
Well, if it made sense for that person.
Right. Of course. Yeah. So I guess my point is, I don't doubt that it will grow. I tend to give my case to things relative to hype. There's been a couple people really hyping this up, and I'm like, we even had Parametric CEO on our podcast, and I asked him, and he said, we'll probably be 5-10% of the quote passive market. Now you think bigger? We'll see.
No. I don't think
lower.
I think lower.
Of the wealth management passive market.
Yeah, maybe something like that.
So what would 5-10% be? That would be $1 trillion?
Yeah, that'd be a cool 500
This
billion or
will
a
not
trillion.
be
Yeah.
retail. This is not going to take ETFs out of the hands of do-it-yourselfers, retail investors. That's not what this is.
I do think when you have a Schwab or a Vanguard getting involved,
They're
or
coming.
a BlackRock,
They're coming.
But I interviewed BlackRock's head of ETFs for the book as well, and I asked him about this, and he had two comments. He goes, one is, we've been doing this for a long time.
For
It's called
institutional
SMAs.
investors. Right.
But the zero commission is what's new,
Yeah,
and
understood.
the technology is miles ahead. What was his other comment?
His other comment was, look, when I walk onto a lot, I'm fine with the 6 choices of cars. I don't need, my own personal car.
Oh, he must not live in America. How many fucking mustards are there on the shelf at Whole Foods?